Guaranteed return investments. If you came across or wish to have come across some guaranteed returns investments, it might be a good time for you to learn what are the potential benefits and risks associated to any type of investment or asset class. Listed equities, stocks and share, potential capital appreciation/depreciation, and potential dividend payment based on profitability, potential full loss in case of bankruptcy. Private equity, potential massive capital appreciation if the company goes listed or you invested in very early stages. Massive depreciation if you can find a buyer, or total loss of the company if it shuts down. Not for retail investors. Corporate or government bonds, also known as treasury notes in US or gilts in the UK, obligations in other parts of the world. Potential capital appreciation/depreciation, depending on the purchasing price versus maturity price and if traded out before maturity date or constant price movement on a perpetual bond. Potential income generator through fixed coupons, potential loss of income if failed to pay its coupons, and potential full loss of capital in case of bankruptcy, default. In June 2015, Greece defaulted a payment of $1.7 billion to the IMF as a more recent example. Commodities, potential capital appreciation/depreciation based on demand versus offer. Mutual fund and ETFs. Potential capital appreciation/depreciation based on the value of the assets held within the fund. Potential fixed percent income paying based on the NAV in sum. Lack of liquidity in property funds, hedge funds, or any other non-daily traded funds. Potential full loss if invested into an unregulated or poorly regulated fund, promoted purely for commission reasons by the advisors. Strategic Growth, Caldora, Premier, New Earth, LM Investments Management as examples. Structured notes. Potential capital appreciation/depreciation if traded, sold, before maturity, and or the agreed observed assets are below the minimum levels at maturity or in some cases during the note set period. Potential income generator. If the agreed observed assets are performing within the set rules, full loss of capital if the issuer goes bankrupt. I met in my career some Lehman Brothers structured notes holders when the notes were not so widely sold as they are today. They lack a solid secondary market, which might create liquidity risk. Properties. Potential capital appreciation/depreciation based on demand versus offer and lending conditions. Interest rates are a massive drive of liquidity and price in the property markets, and potential rental income if occupied by a paying tenant. Some went through the experience of having non-paying tenants for a considerable amount of time. If someone guarantees you an income from property, your promised income has been paid by you in the purchasing price of the property, hidden of course, and returned over a period of time. Private lending. Potential income through interest, usually higher than the one a bank would charge, and potential capital appreciation, if in a rollover type of interest payment. Potential full/partial loss if the debt cannot be repaid as agreed. We know that these days people are being offered private equity solutions while they actually are nothing but private lending. Cash. Cash is king, they say, but it is usually eroded by inflation. Potential capital appreciation if in a fixed deposit with a bank, usually paying an interest rate below inflation rate. And if above, do wonder why, as not many Lebanese bank deposit deponents did. Potential losses of large portions of capital if the bank goes bankrupt. The Cypriot bank crisis is a recent example. Under the EU legislation, deposits are assured up to EUR 100,000. For anything above that, you would need to arrange insurance. Comes with a cost. Keeping it under the mattress. Also has the risk of fire, flooding, or robbery, plus, in some countries, large amounts of cash can easily bring a money laundering investigation upon you. Other. We came across FX schemes, container investment schemes, painting schemes, agroponic schemes. Most of such investment schemes are nothing but a Ponzi, and they are targeting people with low or no knowledge in investments by promising very high returns and low downside risk. highly unadvisable from a risk and liquidity perspective. With all of the above in mind, we will let you judge which investment can actually bring you any guaranteed returns. In investments, we should always have a risk versus reward approach, and if we ever forget the word risk, then we should also start believing in unicorns. Always keen to hear your views and comments. Good luck investing and stay safe while doing it. For more information, visit our website at investexplained.com.